I'm delighted to be joined today by Ben Rockell and John Hubbell of Kingsbury Partners. Welcome, boys. Thanks for coming in. Appreciate it. So let's just dive straight in. Firstly, tell us a bit about yourselves and who's Kingsbury Partners.
Yeah, so Kingsbury Partners been around for about a year now, just coming up to a year. So Ben's background is a qualified financial advisor. My background, I worked at KPMG and then worked for a bank in the UK. We were looking at different investment options for sort of Ben to distribute around his network, but we really wanted to delve into the due diligence of these different investments that were around in Dubai, but just generally in the offshore market.
Okay.
And we wanted to be able to distribute these investments with confidence. What we found after looking at 112 different investments were that...
You looked at 112?
Yeah.
Right, okay.
Yeah, so we created a full due diligence framework and really sort of drilled into what the underlying legal documents were saying in these investments and things, and why they were so popular with, retail clients, okay, should we call them, in the offshore market. And generally the marketing of these products didn't match up to the underlying legals, the underlying accounts, the finance, and that's what I used to do for a living. Back in the UK was the analysis of it. So we found a gap in the market there. There were financial advisors, there were wealth managers, a couple of smaller family offices that were really looking for some juicier investments, and they were getting sort of drawn into a lot of the marketing collateral and materials that some of these companies that were operating in the offshore market were effectively selling.
Okay.
High commission products, track record, there or not there, you can't really figure it out. A lot of smoke and mirrors. So we basically tried to create a framework that distilled all of that information. Give us this, give us that, give us the legal information, and to present that information to people that might be interested in these products, selling these products, introducing these products, things like that. This is what we found. Non-advice basis, just really distilling the market. That's how Kingsbury was born, through that ethos and just trying to do the right thing by people. It was the basics of the business. I want to sleep at night, and that's what I always say to Ben. That's my number one priority, is that I can sleep at night, and would I put my mum into anything that we might be sort of interested in.
Okay. Well, thanks for that. I think, obviously we've set this podcast up mainly to try and help people, navigate the what goes on here in Dubai. Where do you invest your money, and what do you need to look out for? What are the pitfalls of investing here? So, Ben, I'll ask you, look, it's an amazing place to live, Dubai. It's full of opportunity, we know that. But what do you think is the biggest maybe mistake that people make when they invest their money here?
When coming to Dubai, I think when a lot of people move over to Dubai, they try and maintain a certain standard of lifestyle, but particularly to sort of live for other people. And they then have to chase these higher return type products. I think, as everyone knows, Dubai is that flashy, glitzy place. And once they've moved over here, they like to sort of present to their family back home that they are living that type of lifestyle. And as we know, it does take a long time to bed in here, build that network.
Yeah, absolutely.
And actually sort of make a living here. I've been here 4 years myself. Initially very, very difficult to sort of...
Yeah, I don't think it's an easy place to come and just start making money. Yeah.
No, and not everyone does make it. There's a lot of stories about people that do go home. And then when they're offered these sort of what's called like exclusive investment opportunities or these high return investments, I think the allure of being invested in these types of projects that might be property or whatever, they sort of jump at them immediately without that guidance from a qualified financial advisor like yourself, as you say.
Yeah, I think a lot of people in Dubai, if they do sort of get through that 6-month hurdle, they can come into money pretty quickly as well.
Yeah,
money that they've never seen before. And everybody talks about investing or doing this or doing that, and the Dubai money is not forever. You're not going to make that money if you move back to the UK or move back or move elsewhere and things. Maybe that sort of haste to invest, you don't actually do the due diligence. You don't actually go through the proper channels. Is your financial advisor regulated?
And there's hundreds of opportunities you could be offered, right? You come over here, there's luxury developments in RAC in terms of property, or you've got sort of private investments. You've got, you look down the road, all these trading companies on the Shakeside Road and on the billboards, etc. You're flooded with opportunities that tell you that you're going to make it big, right? Essentially, you can't avoid every single bad decision without that right guidance.
Yeah, and I think a lot of people as well, for a lot of people, they've not had money like this before. They might have come from the UK, might have hit it big here, and you're earning big money, and I suppose, you don't know what to do with it. So maybe you do fall into that trap.
Yeah, and I think Dubai is commission-based, it's sales-based. Everybody is almost self-employed out here.
Yeah.
So it's lumpy. It can be quite big chunks, but it can be, you can go 3 months without earning anything, then earn £250,000 in one chunk, and it's how you actually manage that, not a regular salary, and why people can be drawn into these things. And a lot of the things that we see and try and get away from is sort of guilting people into, what are you doing with that? You've made £250,000. What are you doing with it? You need to get it invested. You need to get it in this. You need to get it in that. And, is that a proper financial plan? I mean, that makes your job as a financial advisor a little bit trickier, right? But
from a financial advisor point of view, the investment is the last piece of the puzzle.
Yeah.
We're financial planners first. So what are your goals and your objectives? What risk are you prepared to take to get those goals? We put a portfolio in place. The investment is the last piece of the puzzle. But I think for a lot of people, that's what they're sold. They're sold an investment without, these advisors or so-called advisors knowing, actually what the circumstances are and what the capacity for loss is and this kind of stuff. Now, I think that, in my opinion, one of the most missold investments in Dubai here is loan notes. I mean, if I hear one of my clients tell me that they've been offered a loan note, I instantly start panicking. Now, can you tell us a bit, or the people watching, listening, can you just tell us a little bit about the fundamentals of a loan note? Because a loan note in itself is not inherently bad. It's just simply a vehicle. So you tell us a little bit about the characteristics of a loan note, and then maybe what makes a good investment with a loan note and what people should look out for.
Yeah, I guess if I cover it off from a technical standpoint, and then you
try and keep it light,
yeah. So a loan note is just it's an SPV, right? It's a promise.
Yeah,
you give us this money, we promise to pay you back. It's a debt instrument generally. Yeah. You can get various different types. You can get standard loan notes, as in a debt instrument. You can get convertible loan notes, which say we'll pay you 12% interest for a year, and then you've got the option to convert that to equity into the company. They've been around in one form or another for since the beginning of time. Right? Yeah. It was written on a piece of paper before. It's quite an easy way to raise capital for a business.
Yeah, it's quite easy for people to understand as well.
Yeah, exactly. The underline of that loan note, or the legal mechanics, must state what the use of proceeds are going to be for this. Right, and if people were effectively promoting or marketing a loan note to say, this is what it is, are you interested? If you're into green energy or real estate or any of the things like these, and people can make their own decision on that. That's the legal documentation of a loan note. The information memorandums and PPMs and all these sorts of stuff. They could really be 2 pages long.
Okay.
They're about 20 pages long, generally, that we've seen. And that's the last thing that an investor will ever see, is the underlying legal documentation. Ahead of that, you'll see all kinds of marketing materials that try and explain why that company is doing it better than this. better than anybody else or doing a completely different thing. But ultimately, what do the legals say?
So it's just so that I'm clarifying it, but it's fundamentally a loan to a company where there's a fixed rate of interest for a fixed amount of time, and then you get your money back at the end of it.
That's
Pretty much it, right?
Everything's pretty much predetermined, right? The interest rate, the term. In very, very short form, it's just an IOU.
Yeah.
It can be on a personal basis, but predominantly those that we see in the market are to companies. Again, predominantly in the UK as well, where a lot of people say it's a more established sort of regime.
Yeah.
But I'll probably take the other point on where you say they're not inherently bad, because they are a financing tool for businesses that are pretty immature, right? Gives them access to capital.
Mm-hmm.
But on the flip side, that's why the FCA in the UK say that these are only for high net worth, sophisticated investors, because they are
Absolutely,
illiquid. They are naturally higher risk.
Yeah.
They don't have to be secured over any assets. They can be completely unsecured.
Yeah.
But of course, they believe that sophisticated high net worth investors, the FCA that is, can take those losses.
Yeah.
Because they're not investing capital that they're relying on.
Absolutely. And this is what comes down to capacity for loss again.
Exactly. Which is what qualified financial advisors do go through with clients. But now I think these tools, going back to the other side, have been used by businesses because they are being created more attractive to the investor than they are to the business. And what I say there is that they've loaded it with fancy interest schedules, monthly, quarterly, biannual, so that people can forecast their cash flow. They've made them with security trustees, which I think will be a point that we can come on to a bit later on.
Okay, good.
There's all different types of assets that they secure them by.
Or not secure them by, as the case might be.
Secure them by in some cases. So that, and then before we even come on to how the introducer or the advisor is remunerated, this is now putting more incredible strain on the businesses that are actually trying to operate these business models. And this has caused some of the issues that we're starting to see in the market, where there's a huge potential issue this year with regulatory crackdowns. More recently in the High Court, as we saw yesterday, one business that went down a few years ago, they came out and said that offering 25% commission was not credible in the information memorandum.
25% commission.
25% commission to
and
the advisor.
We've seen them higher
than that.
That's outrageous.
And this is the thing that people
the general public they're investing in, they have got no idea that their advisors are getting this.
It's in the information memorandum, but like I said, that's why they bury it.
Okay.
So generally, it is in the information memorandum. It'll be under something like professional fees or marketing fees or distribution fees, something like that. Something that doesn't say this is a commission.
Yeah.
This is a commission. But
I think I'll add to that point where you say the advisor's getting that. The advisor might not be getting that gross commission. There's 4 or 5 layers above that who are all getting paid out on that basis of that investment as well. So there's overrides upon overrides. So whilst your advisor might be getting, say, 10%, which is still an outrageous commission.
Absolutely.
They might tell you that even up front. You might be happy with that, but you've got to consider the layers of networks and distribution and how that works in the industry in particular to where your money is actually going. And we did an awful lot of work on, for us, how commissions impact the strain on the business. So they might be paying the investor, say, 10, 12%. But if you add in the commissions that are indemnified, which is a term we use in the industry to say upfront, essentially paid on day one, is that you're only deploying, say, 80, 75, 70% of that capital. And that means that remaining 70%, before we come on to operational expenses of the business as a whole, how does that 70% then translate into that 112, right?
And the reason why that works, right, is because, you know, if you're an investor, generally you will pay the entrance fees, as it were. So you've got £100,000 to invest. To gain access to that, you might pay a 1% fee,
okay,
right, or a 3% fee, or a 5% fee. These have sort of flipped that on its head and said, well, actually, you don't pay any fees to access this. It's 100% of capital allocation. Okay, that's great. But that means that on day one, because you're advisor and that chain that Ben just mentioned is getting paid up to 30% in the commission. If you've got £100,000, usually, okay, you lose out on your 1% that you might pay entrance fee, but your capital, only 70,000 of your capital is actually going to that business, because it's got to pay that big sort of chain of command prior to that. So that's 70% allocation plus your 12% that you know, if you're getting 12% a year, you need to make 100% return on that 70,000 just to break even.
Yeah, I think the worrying thing about these as well is, I mean, as soon as we got regulated in the industry here, my phone was ringing off the hook from these sort of guys. Look, we'll offer you 14% commission, 18% for the client, 14% for you. I mean, that's 32% before there's even an overhead in this. I mean, if a cost of capital to a business is more than 30%, I mean, surely that business is seen as a basket case. I mean, you know, who's going to invest? Who would invest in a company like that if you actually knew what you knew of this?
So this is exactly how we formed our strategy of going, okay, if you are going to pay, you know, not up to 35% cost of capital and things like that, but if you are going to pay 20% cost of capital, which businesses actually need that cost of capital? If you say that you've got a 5-year track record or a 10-year track record of doing this, and you're still paying 25, 30, 35% cost of capital, there's something wrong there.
Absolutely.
Right. So if you are going to get these, you know, lucrative investment, and you want to support these companies and you know, and you want those levels of return, is that generally it's got to be for the first 1 or 2 years that a business has been around. Because as soon as you've come into the 2 year, you need to be transitioning to a low cost of capital because you have got that track record.
Yeah, of course, yeah.
But
I think one of the characteristics of these is that there's some of the firms that have been going a few years, we're starting to see the commissions go up and the returns to the clients go up because they need to keep funding it. And I think one of these things is what happens is
these get shorter as well.
Yeah, and these investments work until they don't, and then everybody loses the money. But until that point, everybody gets paid their income, you know, so you think everything's rosy, everything's going well, everything's nice.
Exactly.
And then you lose your money overnight. Everything's gone. And I think that's what's worrying.
So that is effectively our, you know, yes or no is, what's the risk of total capital loss?
Yeah.
Right. So can I see some level of security? Forget how you might value that security. You know, if it's a house on a quick sale arrangement, for example, you might get 70% of the market value of it. But I don't really care about that side of it. But what's the risk of you losing all of your capital?
Yeah.
And in some of the ones that we've seen go down over the last, you know, 2 or 3 years in this sort of space, it's been 100% cost, you know,
100% loss. Yeah, no, I totally agree. And I think, let me ask you this: what are the sort of? I mean, there'll be people listening to this thinking, you know, I've got this. Yeah, I've got something that sounds like this. I'm getting 18%, you know, per year on this investment, you know, or I'm looking at one at the moment, you know. That. So, what are the other sort of buzzwords that advisors might be, you know, trying to sell these things with? Because I know I've been told about 100% asset backed and this kind of stuff. What else should people be looking out for and be wary of?
Let you do the marketing.
Secured, asset backed, and I think this brings into the point about the fully regulated security trustee, which is that, as they sell it, that regulated vehicle that sits on top and manages the security, what they say, on behalf of the investor.
That's how it's marketed, right?
Yeah, which means that the investor perceives that as in they're there to ensure that the investment is de-risked, perhaps.
Okay.
But actually they're just a very, very expensive insolvency practitioner for when everything goes wrong. They'll just liquidate assets if they are there. Then they do nothing during the course of the investment. So if they happen to turn up once the insolvency has been had and there's no assets, that's where the issues really start to unravel.
Okay, so what would you advise investors if they're happy with, you know, the risk, you know, they really want to chase these higher returns, and what would you recommend? How do they research these products? If they're being sold one of these things, what should they do in terms of research? Can they do their own research, or do they have to just rely on what their advisor's telling them?
I think that's what we've tried to do from a transparency perspective, is that, you could check out our website and we've got insights and articles about what to look for and the spots and things like that. And that's how we created our sort of framework. So, and just scoring it based on, what's the background of the management team? How many companies have they got on Companies House in the UK? Like, what's the transparency level? All these sorts of things. And we really just drilled down into what we've seen a lot of, what would we expect? Yeah. What would we personally invest in and invest the company through? And we basically just came up and gave them all a score.
Okay. So you've actually done some DD on some of these things that are out in the market.
Yeah.
Okay.
12.
I think.
Oh, right. You've actually got, and these are available on your website, are they?
It's difficult from the laws here are quite difficult about defamation thing and things like that. So that's the way that we sort of get around it and speak to people around it is that this is how our product and risk committee views these. Okay. This is why we've not taken it on from a product and risk committee perspective.
Yeah, simply we ask the question is, are these investments of good value? And what I mean is the investor getting a decent enough return in correlation to the amount of risk that they're taking on? Okay. Exactly as you do. Is what is the risk-adjusted returns of these products? Okay. You might be getting 18% over here and 10% over here, but the amount of risk you're taking on for that additional 8% vastly outweighs the return that you're getting. Okay. And that's where we've tried to really bring private markets, which of course it lacks transparency, lacks historical data, but there is an appetite among investors for that. And we try to fill that gap, as opposed to public markets where there's all these different criteria, theorems that we have to study when we qualify to measure risk and risk-adjusted returns as a whole. And we've just tried to sort of develop that criteria to assess these private credit as a whole, which is now the buzzword. I think we will probably touch on that as well, is how these low notes and sort of debt instruments are now the new term buzzword that you need to watch out for is probably private credit. They're sort of morphing into that. It's a term that we used over a year ago, and we've seen the market seem to adopt it.
It sounds a bit fancier, though, doesn't it? It sounds a bit nicer. Private credit.
Yeah. It's an institutional term, right? We were at a conference last week in Abu Dhabi called the Private Credit Conference, and you've got BlackRock, KKR, all the big institutional firms that are in the private credit space. Yeah. It's and I guess that's what people do to try and adopt that level of
legitimacy.
Yeah. So all right. So we've talked about a bit about capacity for loss and retail investors. So your average Joe in the street. So what type of investor do you think might be suitable for these type of investments? Because I'm not saying the ones that are 18% with 14% commission, and I mean I don't think there's many people suitable for those, but who do you think suits private credit investments?
When the FCA come out with the guidance, there's similar guidance here in terms of professional, sophisticated investors. And there are criteria around it, 4 million dirhams net worth here. The UK sort of chopping and changing around it at the minute. But,
So it's high net worth investors, right?
Yeah, but you've got high net worth people that aren't sophisticated investors.
Okay.
And that
I don't think the FCA say, probably shouldn't say this, but I don't think a high net worth investor is £100,000 with £100,000 salary with 250,000 in, I think, investable assets, not including their primary residence. I mean, you deal with high net worths, ultra high net worths. They like to have what we call their little play, right? Because they've done the work with you in that 80% of their portfolio that's just going to sit there. Yeah, they don't have to worry. What we in the industry, probably the boring stuff that people don't like to sell, right? Because investors like to have that bit of, we call it a bit of juice in their portfolio. And we had that the other day, right? We came across a client who I think would have been the perfect person to have been sucked into these types of products, where they were like, look, help me. Where do I invest the money?
I guess we can go through the sort of case study. I'm sure he won't mind. I obviously won't mention his name, but again, it's in the sort of lumpy commissions and with his line of work, and came to me and said, I'm earning a hell of a lot of money, but I don't know what to do with it. I'm spending it on rubbish. I'm doing this and doing that. And I said, the first thing, I'm not going to say anything. The first thing, do not tell anybody else about this. In Dubai, especially, as soon as you say that, you're wrapped into a 30-year savings plan and all these things and that's why we use you, right? For any of our clients that come to us and say, look, I like the sound of this. You know, if I'd have been a worse person, I'd have said, look, you could put it all into some of our stuff, but that's not what he wanted. That's not what he needed. I don't know, but we've got, it's the opportunistic people of and that's people taking over Dubai of taking advantage of that.
Yeah, I think that's we're seeing that a lot. I mean, I see so many people that have been banned by these type of things. But I suppose from you talked about people get caught up in the Dubai lifestyle, and I think financial advisors are guilty of that as much as anybody. And I think it becomes, if you come to us and you've got a couple of £100,000 to invest, and we put together a financial plan for you and put together a portfolio, we charge you a fee for doing so. We don't take commission from anybody. We will never take commission from anyone. If we're charging a fee, but then there's a financial advisor that can get 14% commission on that 200 grand, well, that's what he's going to do to fund his own lifestyle, and it's not always what's in the best interest of the client.
And I've been here 4 years, right? Worked in a wealth management firm previously. There's been huge changes regulatory wise with different product offerings, and you've seen that evolve. Where people were used to lifestyle selling the same sort of thing. First one, life insurance, paid out huge upfront commissions. Yeah. Next one, pension transfers, exactly the same.
Yeah,
people's earnings have depleted, or the product offering they can offer to clients, which meant they've had, and they're used to this lifestyle, as you say, live on the palm, play golf memberships, etc.
Yeah,
they've still had to chase these high commission products rather than really getting your hands dirty and building a
doing what's right for the client at the end of the day, which is what we're here to do, right?
Yeah, we say it all the time, sort of between us, but a guy can land off the plane and be a financial advisor tomorrow. He could be selling pens, but he's not. He's selling investments, or he's trying to give financial advice at a lot of these places. And
I think one of the difficulties that people have here, your average Joe investor, is that you can go to a regulated advisor, a regulated firm with a good reputation and all the rest of it, but the advisor can just slip to the side and sell an unregulated product.
Even these regulated firms are offering them as well.
That's what I mean. Yeah. So how would, I suppose my question is it possible? How do people that think they're dealing with a regulated firm, but are actually buying an unregulated investment stacked with commission? How do they know how do they know that they're doing this in unregulated stuff?
Yeah, I guess that's the catch-22, right? That's what we talk about all the time. Is that it's an education piece, but the problem is that people go to financial advisors so that they don't have to worry about that sort of thing. Is that they're not financially literate, or the best financially literate. They've got too much on the plate because they're working hard. They're wrapped up in the Dubai lifestyle. It's hard work living here. So that's the thing that they sort of pass off and go, right, well, I've got X amount to play with, or I've got this, I've got whatever else. So that they're not qualified themselves to be able to do it, and they don't really want to think about it. But we saw something on LinkedIn that came up the other day. What was it? 25-year savings plan. So they thought that was just ticking over in the background. That was growing their wealth, and that was their pension. That was their rainy day fund, and they basically just scraped by. Like, once they'd paid for all the commissions, and they broke even. Don't
worry, we're going to have a full podcast on right. That. Like, that's for another day. That's one of my next ones, I think. But they're pretty scary as well, I would say. I mean, what advice would you give someone then that's maybe listening to this, watching this, saying, right, I know I've got one of those loan notes, or I think I've got one of those. What can they do? Like, if they've already got it, are they
just ask for the information memorandum, private placement memorandum? Just ask for that. If anybody's trying to say anything to you, just ask for the underlying documentation. If you've already got it, it'll be probably in one of your welcome packs or something like that, or you'll be able to sort of dig into it.
So they can just ring the provider who ring the company and say, right, I want to see this private placement memorandum.
Don't send me any marketing information. I just want the underlying PPM, IM, what it's called, various different things depending on where it's offered and which jurisdiction it falls under. But information memorandum or private placement memorandum, go in there and dig through and look for marketing fees, professional fees, distribution fees, something like that. That will give you a good idea of where your money has actually gone. Has it gone to the company directly, or how much fees and sort of expenses are?
So, but they won't be able to find out what their financial advisor was paid, because this is not. It's not. It'll be hidden in the, professional costs or whatever. So they won't actually know what their advisor's been paid, right?
Yeah.
Okay.
It's not disclosed anyway.
Okay, so we've seen some of these things already go, right? And the people have lost all of their money. There's probably one that's going to go later this year, which has been maybe put back. And no doubt there'll be others that follow. What do you think the future looks like for these type of investments? Because I think some of the firms that are selling these, or some of the individuals that are selling these, just think, well, there's another plane landing tomorrow. I'll just go and keep selling it. Do you think they can continue, or do you think it's going to catch up? I mean, this is what we're trying to, spotlight what's going on, and try and educate people about it. But do you think it's still going to continue? Do you think people will still keep buying these things?
Probably, yeah. To be honest,
the industry evolves, right? It changes its name, evolves into a different structure. Something will come out, and someone's making a lot of money out of it.
There's no doubt about that.
And a higher commission product will come out in the next few years, and the industry will chase that.
Yeah,
it might not be. It might not be a
regulation catches up.
I mean, look at, you're sort of seeing it already with structured products, structured notes.
Yeah.
Now that's just equity. It's just a commission printer. Really.
Yeah.
That's how I see it. I can't. If you want equity options, go and buy the equity. And if you are a professional, high net worth, sophisticated investor, you're probably already exposed to the equity side of it.
Yeah.
So that's part of the sort of marketing, but it is an alternative investment. It is a sort of hedge against the stock market.
Yeah.
And things. But it, like you said it right at the beginning, it's got to come last.
Absolutely.
You've got to get 80, 90% of your portfolio, even 100% of your portfolio, to really build that traction. And then go, if somebody comes to you and goes, Dave, I want something a little bit juicier. These products have got to be, we try and act as a buyer's agent, rather than a seller, right? If people come to us and go, you haven't got something about, 13, 14, 15% in something a little bit different. And then we go, well, we've not done the full due diligence on it. We don't know the complete ins and outs of it, but it might be a good opportunity for you. And that's where you sort of track, but it's got to be reverse inquiry, right? It can't be just going out and.
No, of course. Yeah. And I've had this conversation with clients all the time. I genuinely think the only way that you can make big money is either your own entrepreneurial ability, so I've got most of my clients are entrepreneurs. So they've been out, they've made money, they use me to keep it safe and to make sure their financial objectives are taken care of, whether that's retirement, school fees, whatever those may be, right? But they go and make money and then they bank it and they keep it safe. I think we've seen maybe I'd put crypto down as I don't understand it enough, but I've seen people make big money on crypto. I'd put that like gambling. I've seen also people win money on gambling.
Yeah.
But I know more people that have lost money gambling, and I know more people that have lost money on crypto. So, but you can't ignore that it's made people, a lot of money that way. I think the other stuff just doesn't exist. I think it catches up with you at some point or another. I just think, you've got to be in that position. I think you said it before, is where if you've got your things taken care of and you might want to look for something a little bit juicier, then that's fine, because you're not betting the ranch.
Exactly.
That's taken care of. It's not going to change your life if this money, was to disappear.
I think when you said that question about how do I know I'm being sold these, or how do I avoid it, is to look at what portfolio you've already got. And if you're over concentrated in these types of products, your advisor's probably very well incentivized to sell them.
To carry on, yeah.
And they might not be looking out for your longer term interests. They probably don't even know what your objectives are at this point.
Yes, I suppose.
And potentially you need to question that relationship with your advisor.
But I suppose, from an advisor's point of view, just look purely from their need to make money. We charge a client a setup fee, and then we charge an ongoing fee. The client chooses to pay it or not, if they perceive they're getting value from me. Whereas if you're an advisor and you're selling these things every year, it comes up every year. Do you want to go back in? I get another 14%. I get another 14%. It's a lot of money, so it's difficult for these kids to walk away from that lifestyle, I suppose.
But it's their only way to earn, right?
Yeah.
In the setup that a lot of the financial advisory companies out here have got, it's their only way to earn. It's the same as the real estate companies out here. It's get as many people in as you can, go out and do business development, and then, that's your sort of commission covered, and that's how you earn money.
Yeah. They're
not earning money from giving financial advice. They're earning money from selling products.
Yeah, I think that's the shift that needs to happen. I mean, I think a financial planner, financial advisor, it should be providing a service and gets paid for a service, rather than selling a product and, getting a commission for selling a product. You're just a salesperson. You're not an advisor. And I also think there's a difference between financial planning and financial advice. Advice might be a one-off bit, and actual financial planning is, right, let's put all of this stuff together. Let's build you out a financial plan. And you're going to find that I think people will have different investments for different objectives. If I've got to pay my kids' school fees for the next 13 years, that has to be absolutely bulletproof, zero risk, and I need that money over there. My retirement might be in, it's getting closer every year, but it might be in, 15 years' time. So I can afford, I've got a capacity of loss with that investment. I can afford to take more risk with it. So I think there is a real difference between the two, and it is a service, the stuff that we do. So I definitely think there's a market for private credit. There's no doubt about that, but it's for a certain type of person, and they need someone, I suppose, like you guys to do the due diligence for them and say, right, this is what we've done, right? So tell us a little bit about what that might look like for you. So what type of due diligence would you do on a firm to say, right, we've done this, we like this company, for example? It's
difficult because to get the returns that people want and are used to from these types of investments and deals and things like that, you've got private equity, which, but that's a long hold period.
Correct. Yeah.
Access is a problem.
Access to those, you're going through sort of fund managers, and you're going through various different avenues, which
high minimums investments.
Yeah. High minimums. But when you're going through some kind of fund structure, the regulatory impacts, the fund structure impacts, the managers, the performance fees, the management fees of those, there's still the same sort of fees that are wrapped up in funds or the institutional level of things. But I won't go as far as 35%, but there are still fees applicable to it. Sort of veering away from your question, but I'm coming back to it, is there's a tranche in the middle, which is private credit, which is income producing. Do you want to be holding it for 5 years, 7 years, 10 years? Probably not, because you'd prefer the upside of private equity there.
Yeah.
So which companies are using private credit? They're generally private equity backed companies. Generally, anybody that looks at the company actually wants the equity in the company.
Okay. Yeah.
Right. And we always say, nobody else wants the credit. That's not because the company's bad or that we perceive it to be bad. It's that everybody wants the upside.
Yeah.
Everybody wants the 10x returns. But if you've already got private equity allocation in your portfolio, then you need some sort of income from that. From how do you actually get income? Real estate is a difficult one for us to get involved with at all, because is real estate income producing? Yes, it can be, but what's your ROI on a buy-to-let property? 5% if you're lucky. So you're not getting that 12, 13, 14%.
Yeah.
So it can't.
Then you're looking at development, which is not income producing at all.
Yeah.
And higher risk. Higher risk.
Yeah.
So it's got to be a cash flow generating asset, or an asset purchase, or a business that's actually producing cash flow generation. If the business is producing cash flow, they could probably get finance a little bit cheaper, debt finance, senior debt, even mezzanine, of that sort of thing. That's why we built the structure around growth stage businesses. When we say growth stage, we mean pre-revenue up to sort of 5 million EBITDA.
Okay.
We basically draw out a picture and say A to B. A is if this company is receiving capital or funding, how are they deploying it? Can they deploy $20 million in one day? No. So you've got to sort of stagger that over 6, 7, 8, 9 months in terms of the deployment. B is your exit. So is that a refinance? Is that a sale? Is that a private equity coming in and buying the debt back off you? What are the exit routes in there?
Yeah.
And the bit between A and B is your income, right? So you mitigate your risk there by deploying the capital over a period of time. You mitigate your exit risk by having 3 or 4 different exit strategies through there. And then the bit that the investors get where there's not really much risk mitigation because you're relying on the strategy of that business, that's where you get your income. So that sort of mitigates it from there. If everything goes wrong, do I, as an investor, have access to that, some level of security? If the answer is yes, great. Right.
Because then you can quantify that risk, right? It was what you was talking about before. So if you know what is my Armageddon, what is my worst case scenario, and as long as the client is aware of that in the worst case scenario you can lose this, then.
And typically the growth stage businesses that we do look to fund, we're not funding the business in terms of working capital. We're looking at their portfolio strategy. What assets are they looking to acquire?
Okay.
And typically investors are looking for shorter terms. So a lot of private credit can be 5-7 years if they're funding the business. We seem to see our investors like 12 maybe to 36 months. So we look at what we call NBFIs, non-bank financial institutions. So we lend from our investors to businesses that then say onward lend. That could be invoice financing, trade finance, or more recently acquiring portfolios of student loans in the US. And why we've done that is that the asset cycle on those types of businesses are shorter, so they fit with our investor appetite. Okay. So that's coming back to the reverse sort of inquiry type thing we were discussing. But going back again is where you see these guys, the terms are becoming shorter, but the asset cycles haven't come any shorter.
Yeah.
I haven't seen planning permission in the UK get any quicker. I know Labour are trying to do that.
Yeah.
But for some reason, the terms on these investments are getting shorter and shorter. And the only way that B point that John was discussing is being paid back is unfortunately other investors.
Yeah, so
you're funding someone else's exit.
Yeah.
And until when that money starts to dry up, which we'll see in this loan note space as more hit the proverbial fan.
Yeah.
The house of cards will come down.
And because these are unregulated, their investors have no recourse on this, do they?
No financial protection.
Gone.
Nothing.
Like it's 100% gone, right?
Because when you have to self-certify as a high net worth, which essentially means that you've taken on that risk. You agree that these are risky investments that you can take on that, so they are illiquid, etc.
And so, what does that look like then? So, are the investors told that do you agree that you're a high net worth investor? You can afford to lose all of this money. Do they go through that, or is that hidden as well somewhere?
It comes back to the information memorandum or PPM.
Okay, so most people don't see it.
It's all in there, and you'll see it on. We've seen it of the 112 that we looked at. I think it's on every single one of them. Is that I have read, front to back the information memorandum. This document, right? We don't know how it happens in the sales process, whether they go just sign there, Mr. Client, or whether they actually do that.
It's not an approved financial promotion, which means that it can only be marketed to certain what they call exempt persons, so high net worth, sophisticated investors. So if they are being marketed to those that don't qualify, that's actually that doesn't fit the FCA's guidelines.
Yeah, but we don't fall under that here, do we?
But it is a UK based financial promotion.
Okay, right, okay. So what are we saying? There is no recourse? No. So, right, okay.
And that, again, in the information memorandum PPM, it will say 100% of your capital is at risk here, as every investment does. And that's, I think, how people get around it, is to go, you've got to put that in there just in case of Armageddon and stuff like that. But we're seeing Armageddon come up a little bit more frequently than what we would classify as Armageddon.
Definitely. And, it's I suppose it's actually really sad, because most of the people that, I've come across that have lost the money on this, they can't afford to lose this. They've gone back years in terms of their financial plans, and it's awful. It's really awful to see what's going on at the moment. Okay, but we'll end on a brighter note. Just what does the future look like for Kingsbury and Partners? You guys have been going a year. Tell us a little bit about what you've got coming up. What does it look like?
So recently we signed our partnership with the next business that we're supporting. It's a business in the US that focuses on education credit or private US student loans.
Okay.
So we're raising $15 million of capital for those, structured as we haven't mentioned it, but a credit linked note. So we've actually moved, we won't look at loan notes at all. We don't believe that the safeguards that they offer are stringent enough for.
I think it's the transparency,
for our risk appetite. Yeah, and the transparency. We've got regulation around that in terms of the counterparties that we do use, and we're very proud to be working with this company, and that will be sort of our focus for the next 4 to 6 months.
Okay,
definitely not 35% commissions. So
no.
What our thing was how do we get paid? Everyone needs to get paid. I understand that, right? But let's defer those commissions until the investors have been repaid.
Okay.
That's how our business is built. We get paid through equity or through a profit share on the back end once all the investors have been repaid, and that's the way that the institutional level sort of works. We don't touch any retail clients or anything like that, but we'd like to see that sort of transcend down towards the more retail end of the market. So if we can set a benchmark and working with institutional levels and people start to adopt that, that's good enough for us.
I suppose it's a bit like what we're doing. We'll never take commission from anybody, and we'll never sell third-party products. We hope that by the level of transparency that we're giving clients, that people are going to have to follow us. And it can only make it a better industry, and a cleaner industry, and have a better reputation, I suppose.
Yeah, and for us, Dave, look, we've got a really good relationship between Kingsbury and Legacy, right? That's our aim, right? We're not trying to give you commission or anything like that, but the fact that you trust us to speak about these things and things like that, that's one of the highest accolades we've got as a business, is that people actually go, those guys are trying to do the right thing.
Absolutely.
And same with you, completely reciprocated on that end.
Of course. Right. Well, I really, really appreciate your time, boys. Thank you very much. I'm sure there was something for everybody in there. So.
Pleasure to be here. Nice to outnumber the Southerners for once.
Yeah. All right, boys. Thanks very much. Really appreciate it.
Cheers, Dave.
Cheers.